So in this period, we are going to finish up from where we started in the last session. So let's continue our class with this question. So this question looks at additional scenarios on how to determine temporary difference and also deferred tax. Don't forget that we are looking at income taxes, and income taxes is about company income tax, which can either be current tax or deferred tax. For current tax, these are majorly the tax that a company will pay or recover in the current year based on taxable profits. And these taxable profits are determined by the tax law. However, there are certain instances where the taxman or the tax law will not agree with some transactions. As a result, it will not be included in the taxable profits, resulting in a difference between our taxable profit and our accounting profit. These items or these areas where there are differences between what the taxman captures and what we recognize in our books, we call it temporary difference. This temporary difference, even though the taxman is not considering it for tax, is not considering it in its current tax, we would need to accrue for those taxes. We would need to factor them in, and that's where deferred tax come in. So deferred tax is not what a taxman does. Most tax people don't even know what deferred tax is about. Deferred tax is more of accounting work. It's more of accounting, it's more of that of accountant than the tax authority. So we will capture all of those temporary differences. We will determine, okay, which of these temporary difference will make us pay additional tax in the future. We will say that one is a taxable temporary difference, and we'll make a deferred tax liability for that. We recognize a liability, deferred tax liability, credit deferred tax liability, debit P&L. If a temporary difference will make us pay, not pay, will make us have a deduction in the future in terms of tax. We'll call that deductible temporary difference, and we'll book deferred tax asset in respect to that. And that was basically what I've taught you so far. Now let's look at further questions. The first question here says that the current liabilities include accrued expenses with carrying amount of 3,000. The related expense will be deducted for tax purposes on a cash basis. What is the deferred tax? Again, to determine deferred tax, we need to identify temporary difference. And from here, it's relating to a current liability that includes accrued expense with a carrying amount of 3,000. Before we close the class, David asked us that why are we mentioning carrying amount? Isn't carrying amount attributable to asset items alone? So I was able to answer that quickly because I know that all the examples we have looked at so far are actually related to asset. So easily I could show him that all those items are asset. But the reality is this: as far as IAS 12 is concerned, all the items in the books of the accountants, all the items in our accounting records, we refer to that as carrying amount, just to distinguish it from what the taxman will capture. Then we refer to that as tax base. So in this case, it's a liability. In our books, we have an accrued expense, an expense that we have incurred but we have not paid for. We have it at 3,000 in our books. But a related expense related to this accrued expense will be deducted for tax purposes on a cash basis, meaning that the taxman is not going to capture it now. The taxman is saying that I'm going to capture this on a cash basis. When you pay for it, then I would capture it as a deduction. I will deduct it for tax purposes. So as it is today, the taxman says he's not going to capture this amount. So his tax base is zero. In this case, we would have a scenario where we would have a deduction in the future. Because yes, the taxman is not capturing now, but that does not mean he will not capture it. He will capture or treat the item as a deduction for tax purposes on a cash basis. When you pay for this expense in the future, he will capture it as a deduction. So we would have a deduction in the future, meaning that these differences as it were today will result in us having a deduction. So it is a deductible temporary difference of 3,000. And that will result in a deferred tax assets, which is computed as 30% times 3,000, which will give us 900. And that's our deferred tax asset. Yeah. Secondly, there is a current liabilities that include interest revenue received in advance with a carrying amount of 5,000. The related interest revenue was taxed on a cash basis. So yeah, we are having a revenue that we received in advance, meaning we received it in cash before we even earned it. We received 5,000. Of course, the taxman was taxed that item on a cash basis. He taxed it on a cash basis. But as it is today, the revenue, the interest revenue received in advance in our books is 5,000. But the taxman has already taxed it in the past. So as it is today, he doesn't have to capture it again. It's not in his books. As of this year, it's not there because he has taxed it in the past. So the opposite of that is that we won't pay any tax again in related to this item. So that would be a deductible temporary difference because it has been taxed in the past. It has been taxed in the past, so it's not going to tax it again. So that's similar to a deductible temporary difference for us right now because it is an item that is now recognized as an income in our books, but we will not pay tax on it because it has been taxed when we received the cash. So we would have a deferred tax asset in respect to that deductible temporary difference calculated at 30% of 5,000, which will give us 1,500 naira. Another one, we have a current liabilities that include accrued expenses with a carrying amount of 10,000. The related expense has already been deducted for tax purposes. In this case, would have an accrued expense with a carrying amount of 10,000. So we have carrying amount of 10,000 related to an accrued expense. The related expense has already been deducted for tax purposes. So the taxman in this case decided to include it for tax purposes. He said, okay, I'm going to deduct it for tax purposes, even though it's an accrued expense. So in this case, the tax base here is also 10,000. So the taxman decided to allow it as a deduction while we also have the same amount in our books. No temporary difference here. No temporary difference here. Another one. There was a current liability that includes accrued fines and penalties with a carrying amount of 3,000. Fines and penalties are not deductible for tax purposes. So in this case, what's our temporary difference? What's our carrying amount? What do you have in our books recorded? We have 3,000. What is the taxman capturing? Fines and penalties are not deductible for tax purposes, which means the taxman will capture zero. It's not going to include it for tax purposes. In this case, this difference is a temporary, is a permanent difference because fines and penalties are never deductible for tax purposes. There is no temporary difference here. It has no tax consequence. So it will not be included for tax purposes. Also, we have a loan payable as a carrying amount of 8,000. The repayment of the loan, we have no tax consequence. So again here, what is our temporary difference? We have carrying amount of 8,000. What's the tax base? 0. Tax because the repayment has no tax consequence. So in this case, what's our difference? That difference is a permanent difference of 8,000 because it has no tax consequences. Okay, now let's look at few past questions. Let's look at past questions. So let me start with last diet question. It was a question on taxes last diet. Then I'll come back to these other ones. Just hold on. Where is it again? Please confirm that you can see this question on taxes on my screen. Please confirm that you can see it.
The screen is
No,
not
sir,
big,
it's
sir.
only the status bar. It is only the bar, sir.
It's really the status bar that you can see. Okay, let's see. What about now?
Yes, sir. See.
Okay, good. Now, this was last diet question, and it was just for 2.5 marks. Just for 2.5 marks. That shows you how simple it is. So this says that income taxes set out guidance of dealing with under provision and over provision of income taxes by reporting entities. It says during the year ended December 31st, 2024, Benson Limited formalized and pay its liabilities for company tax on profit for the year ended December 2023 at 31.5 million. It had previously made an estimated provision of company income tax of 37.5 million in the financial statement for the year ended 2023. The director estimated the liability for the year ended. Okay, this is very straightforward. Extremely, this is just similar to the ones we have solved. So they want you to explain the treatment of the above transaction is in the financial statement of Benson in respect of income tax. So you will look at it that in 2004, this is the estimate of tax in 2004. This is liability for 2004. This is what goes to statement of financial position. And of course, P&L for 2024. However, we will need to make adjustment for current tax of prior period. He had estimated 37.5. At the end of the day, he formalized and paid 31.5. In this case, are we going to have a situation of over or under provision for tax? Who can tell me?
Under.
No, no, it's not under.
Over provision, sir.
It's over provision.
It's over provision now. He provided for 37.5. He is paying 31.5. So that difference of 6 will simply be deducted from this 36.8 to determine what goes to P&L. But is this 36.8 that goes to statement of financial position? So I need you can try it, write it down. This is so easy. So I thought it was something serious. So that was the question on income tax for last night. So let's go back to our notes. Okay, please confirm that you can now see my note.
Yes, you can.
Good, good,
Confirm,
good,
sir.
good. So now, the first question states that Wasi PLC buys an item of equipment on 4th January 2001 for 1 million. It has a useful life of 10 years and an estimated residual value of 100,000. The equipment is depreciated on a straight line basis. For tax purposes, a tax expense can be claimed on a 20% straight line basis. Income tax is 30%. You are required to calculate a deferred tax charge or credit in the statement of profit or loss for the year ended 2002 and a deferred tax balance in the statement of financial position. So deferred tax credit and deferred tax balance for 2022. So what's happening here? We bought an asset in 2001. The useful life is 10 years. The residual value is 100,000. They depreciate it on a straight line basis. For tax purposes, capital allowance or tax depreciation is okay. Now, you see, to solve a question like this, since they are asking for deferred tax charge or credits that goes to P&L and the balance that goes to statement of financial position, if you go ahead and just do something like this, you know that we can do to calculate deferred tax at any point in time. I told you that you do temporary difference. Now, we can do carrying amounts, which is costs minus accumulated depreciation. Now, if you do our costs, what's the cost of these assets? Cost of these assets is 1 million in 2001. Your depreciation is simply 1 million divided by the useful life, which is 10 years. My depreciation is simply 100,000. Now, I will get my carrying amount at
What
the
of the
end
residual
of,
value?
yeah, thank you very much.
There's a residual value.
Yes, there is actually. There is residual value. actually. Okay. So now, what would this give me? It gives me 90,000, right? 90,000 as my accumulated depreciation at the end of 2001. Even though the examiner says I should do for 2002, I cannot rush and I can easily get carrying amount at the end of 2002. I just multiply this by 2. That will give me depreciation for 2 years. But if I should jump there and I get deferred tax, my deferred tax charge will be wrong because deferred tax charge is the difference between the closing deferred charge at the end of 2002 and the opening deferred tax charge and the opening deferred tax at the beginning of 2002. So I have to do it I will have to do opening and closing. So in this case, I have to get my opening deferred tax first. So my carrying amount as at the end of 2001, which is the previous year, is 910,000. And my tax base, which is also the costs of this item, which is still 1 million, then my tax accumulated depreciation, which we call capital allowance in Nigeria, is also 1 million. In fact, the tax man uses 20% straight line. 20% straight line. And that will be how much? And that will be 200,000. The tax man uses 20% straight line. So the difference between the two is 800,000. Then I have a temporary difference here. I have a temporary difference here of 110,000. Now, let me ask you, this temporary difference at the end of 2001, is it a taxable temporary difference or a deductible temporary difference? Who can tell me? Anyone?
It's a temporary difference, because it will charge against the next tax year, 2002, if the trade still continues.
No, you haven't answered the question. Is it a taxable temporary difference or a deductible temporary difference?
Okay.
Can you scroll up?
Can hear you.
Taxable.
Why taxable?
Taxable,
Can you
sir.
scroll up? Let me see the question, sir.
You don't need the question. Everything you need is on the board here.
It is taxable, sir,
Why is it taxable?
because the carrying amount is higher than the carrying amount is higher than the tax base, which makes it a tax liability.
Who taught you that one? I've never mentioned that.
Can
What's
I
the
try?
logic?
Okay.
Yes, please.
It should be tax deductible because what this means is that your accumulated depreciation, the one you calculated, is lower, so you should have charged more. So it means that they are trying to tell you that you should have charged more that will reduce your liability. I don't know if I'm correct.
No, you're not. So what exactly have I been teaching you since morning? You are saying what I did not even teach you. You are saying something else entirely. Is it that you're not listening or you're just clicking, you're just clicking present? I'm asking you the first question I did when I taught you deferred tax. You are saying something that I did not say. Maybe this is it. This is an example here that we did a carrying amount of this asset for 2.5. We did a tax base of 3.5. Somebody will ask the question. I said the interpretation of this, as far as income tax is concerned, this carrying amount means the amount of depreciation, accumulated depreciation you would put in your books. The amount of depreciation you would charge in your books in the future. What this tax base means, the deduction the taxman will give you in the future. Apparently, the taxman is giving you more deductions by 1,000. It's giving you more deductions by 1,000. So I called it deductible temporary difference simply because you are getting more deductions. So I did not interpret it as whenever you see the carrying amount that is low. I didn't want you to cram that. Even though it works in most cases, but when you forget that, okay, when the carrying amount is higher than tax base is this, when the tax base is higher than this is that. I didn't mention that intentionally because that's cramming. Cannot cram your way out of a professional exam. To a large extent, there is a reason for everything, and I explained that to you. The same thing here now in a past question. You see it's the same thing. The carrying amount is 910,000. The tax base is 800,000. In this case, this is the deduction the taxman will allow you. It's just 800. You are going to have 910 as depreciation in your book. So which means that you will get less deductions. You will get less deductions. So that's the opposite of deductible. That's simply taxable temporary difference in this case here. You have to understand it so that you will never get it wrong. And if you don't understand it, you say, please, sir, come again. And we explain again until you understand it. So if I'm moving forward, I'm assuming you understand it. I cannot ask you what I've taught you before and you're saying something else entirely. So deferred tax liability here, given an income tax rate of 30%, would have 30% times 110,000. In this case, we will be having 33,000. We'll be having 33,000 here. And as far as this question is concerned, this can represent my opening deferred tax because this will be carried forward to 2002. So at the end of 2002 again, I will compute my temporary difference again by comparing my carrying amount now with my tax base. And my carrying amount now will simply be, I can either continue from here, which is 910,000 minus my depreciation for that year, which since I'm using, it could just be 90,000. I can do costs just to make it easy for you. I can do costs minus accumulated depreciation. We already know that it's 90,000 per annum depreciation. So I can do 90,000 times 2 years now, which is 180,000. So my carrying amount here is that should be 820,000. 820. My tax base, again, my costs is this. My tax depreciation, my tax accumulated depreciation, since I know that it's 200,000 per annum, I can just do 200,000 times 2 years. And that's 400,000. So 1 million minus 400,000, that's 600,000. Again, the deduction I will get, that's the interpretation when it comes to PP, deferred tax on PP. The way you calculate tax base is what I'm showing you, and the interpretation is the meaning of this tax base in this context is the deductions you will get over the remaining life of the asset. This is the depreciation you will charge over the remaining life of that's the interpretation. So if your deduction is lower, that means you are having a taxable temporary difference. That's why some people just cram it without understanding it. If you understand it, then you cram and have a methodology. That's fine. I don't have a problem with that. That when your carrying amount is higher than your tax base, that's the taxable temporary difference. For assets, you never get it wrong. It's always right. But I don't like people cramming out of context without understanding what you're cramming. Just cramming. If somebody asks you why, you say it's because the carrying amount is higher. No, it's not because carrying amount is just higher. It's because the deduction you will get is lower than what you are going to have in your own books. That's why you're having a taxable temporary difference, because the temporary difference will result in you paying more tax. You're going to pay more tax. So here, the deduction you are getting is lower. And there is, in this case, there's a taxable temporary difference of 220,000, resulting in a deferred tax liability of 30% times 220,000, which is 66,000. So this 66,000 is the closing balance of this is the deferred tax balance in the statement of financial position. That's the deferred tax position as at the end of the year. But the deferred tax charge in P&L that goes to SOPL is the opening deferred tax liability, which is 33,000. Compare it with the deferred tax liability, which is 66,000. There is an increase in deferred tax. That increase in deferred tax will give us deferred tax expense. If it's a decrease, that will be deferred tax income. So this is what goes to SOPL. So if I prepare my SOPL, I will have a deferred tax expense under my income tax expense as 3,000. And in my statement of financial position, I will have a deferred tax liability, which is usually under non-current liability of 66,000. It shows under non-current liabilities. And that's how this question would go. That's how this question would go. So there's nothing, this is not different from what I've done so far. We just really need to get the opening so that we can get what goes to P&L. That's just the additional thing here. Now, let's look at another context. Now, look at this. It says that Wasi PLC purchased some land on 4th January 2007 for 400,000 on 31st December 2000. Now I said on 31st December 2008, they revalued the land to 500,000. We're now told that in the tax regime in which the company operates, revaluation do not affect either the tax base of the asset or taxable profits. or taxable profits. The income tax rate is 30%. You are required to prepare the accounting entry to record the deferred tax in relation to this revaluation for the year ended 31st December 2008. So here, how do you record the deferred tax in this instance? First, we need to even determine the deferred tax by ascertaining a temporary difference. And how do we get this temporary difference? It's by comparing the carrying amount, which in this case, we are talking about 31st December 2008. Again, we're given the costs of these assets. We purchased it in 2007 for 400,000. And in 2008, it was revalued to 500,000. That means the carrying amount now is 500,000. That is the book value now. And in the tax regime in which the company operates, revaluation do not affect the tax base, meaning the tax base, the taxman does not consider revaluation. So as far as the taxman is concerned, the value of these assets remains 400,000. So in this case, they are assuming no depreciation because it is land. Lands are not depreciated. So here now, we have a temporary difference. And this temporary difference now, I want to ask you again, is this a taxable temporary difference or a deductible temporary difference?
Taxable temporary
Taxable.
difference.
Good.
Tax,
Perfectly correct. Taxable temporary difference of 100,000. And when we have a taxable temporary difference, would have a deferred tax liability, which is computed as 30% times 100,000. And that will give us 30,000. Now, who can tell me this 30,000? The question asks that you should prepare an accounting entry. When you see a question like this question is expecting you to do a debit and a credit. If they say accounting entry, you have to do debit and credit. So who can tell me the debit and credit for this?
So let me try.
Okay,
We debit income tax expense and credit deferred tax liability.
that's correct. Debit income tax expense and credit deferred tax liability. That's correct. So this deferred tax, income tax expense, where does it go? Where will you put it? Which statement?
SOPL.
P&L. P&L.
P&L, P&L. Okay. What about this deferred tax liability?
Statement of financial position.
Good. But you're wrong here. This is OCI. Who knows why I said OCI? Why are you
Yes,
wrong?
yes,
Why?
yes, yes, because the
Uh-huh.
revaluation surplus which goes to the other comprehensive income.
Fantastic, Michael. Fantastic. Fantastic. So revaluation surplus goes to OCI because if you look at it, this temporary difference here is arising because of revaluation. It's because they revalue the land. That's why we are having a temp. If there was no revaluation, the land will still remain 40. So there won't be any difference between these two. This difference of 100,000 is evaluation surplus. And evaluation surplus goes to OCI. The related tax will go to OCI. And I told you when we started class today, it's about matching concepts. Wherever the transaction is recorded, that is where the tax will go. So this will go to OCI. Okay, I can take a few questions now before I move to question 3.
So yes, if we can look back at the question 1, I wanted to ask, just for understanding sake,
Yeah.
that 30,000 at the bottom, sorry, I mean 33,000 at the bottom. Yes, I wanted to ask, like, why do we see the decrease in deferred tax liability as an income?
Oh, that's the nature of liability. That's the nature of liability. So when liability is increasing, is an expense. According to the conceptual framework, defined an expense as an increase in liability, decrease in assets, right? So income is an increase in assets, decrease in liability. So that's the very foundation of accounting. That's the very basic accounting. So when liability is increasing, is an expense. When it is decreasing, is an income. That's why.
Thank you, sir.
Good question. Any other question? Okay, let's solve this question 3. This is also a past question. All of these are actually past questions. I'm just extracting them from. So this one, they said they gave us a trial balance. We were given deferred tax of this on the trial balance. We're now given additional information. We're told that the directors of the company have estimated the provision of income tax for the year ended 30th September 2018 at this amount. The required deferred tax provision at September 30th is this amount. We're now required to prepare a statement of profit or loss and a statement of financial position. So in this case, the estimate of current tax first. See, estimate of current tax for 2018 is 2280. It's 2280, which is this. That's the income tax for the year, right? And the deferred tax, the deferred tax estimate for the year is 1200. However, there was an opening deferred tax. So as far as deferred tax is concerned, if I want to use this to determine my income tax expense that goes to P&L, so I've gotten estimate of current tax that goes to P&L, but for deferred tax, you do my opening deferred tax. Whatever deferred tax you find in the trial balance is the opening deferred tax, but that would definitely represent brought forward. While my closing deferred tax will be found, is done at the end of the year, and it will be found in the additional information. So there is an increase in deferred tax here. We have an increase in deferred tax, which will be a deferred tax expense. You see, in this case now, you see that they didn't tell me whether it's a deferred tax asset and liability, but yeah, I can figure it out because it's on the credit, the deferred tax liability. So I have an increase in deferred tax of 40. So my income tax that goes to POL is simply 2320, right? This goes to POL And my statement of financial position. So if I want to prepare my SOPL, my income tax expense is simply the aggregation um, of the current tax and the increase in deferred tax. My statement of financial position under my non-current liabilities, I will have my deferred tax liability, which is the closing deferred tax liability of this one 200. And don't forget, under my current liabilities, I'll have my current tax liability, which is this 2280. And that's the solution to this question. That's the solution to this question. Okay. Now, next, we're told that Wasi PLC revalued a property from a carrying amount of 2 million to its fair value of 2.5 million during the reporting period. The property cost 2.2 million. Its tax base is 1.8 million. The tax rate is 30%. Explain the deferred tax implication of the above information in Wasiu's financial statements as at the end of the reporting period. Now, this question really wants us to explain. So when you have a question asking you to explain, you really need to do some explanation to them. You can do your workings, then you present your solution more of like an explanation. You need to explain everything you've done. Now, here also, I'm required to explain deferred tax implication. Whatever it is, that will be a deferred tax implication. I know I would need to calculate temporary difference, which is the difference between carrying amount and tax base. Since they have revalued the asset to 2.5 million as of now, that means the carrying amount of the asset is 2.5 million. Now, this 2.5 million, just for the purpose or ease of, let me do it like this. This is still the same thing as 2.5 million. I hope you know, changing it from millions to thousands. And my tax base also was given to me as 1.8 million. So there's a difference here. Again, you can tell me, is this difference taxable temporary difference or deductible temporary difference?
Taxable.
Taxable.
Correct. Taxable temporary difference. And that taxable temporary difference gives me how much? 700. I will have a deferred tax liabilities of, what's the tax rate? 30%. So 30% times 700,000. And that will be around how much? That's 210. That's 210. Now, this 210, how am I going to record it in my books? Of course, I will debit and credit deferred tax liabilities of 210. I will debit my income tax expense or deferred tax expense. Well, am I going to debit it with 210? Now, I have to be very careful because um, um, fair value. There were some of this amount that was arising from fair valuation and is a property. Okay, so let's assume this property is not investment property. So let's assume this is like a land and building. Okay, let's assume this is land and building because if it's investment property, changes in fair value goes to P&L. So deferred tax there will go to P&L also. So no, there's no technicality there. So if it's PPE, fair value surplus goes to OCI. So deferred tax will go to OCI. Now, but in this case, the difference between this 2 million, okay, the carrying amount of 2 million and 2.5 is not the only thing causing this temporary difference. So I cannot say that this 700 temporary difference is solely arising from the fair value surplus or evaluation surplus. So what point I'm driving at is the portion I can take to OCI, okay, the deferred tax I can take to OCI out of this is the one relating to the revaluation surplus of 500, which is 150. You see, the remaining will go to P&L because that one is not arising from the fair value surplus. That's the point I want to do out here. It is the remaining 60. That's what I want to do out for you guys here. So there are some instances where the revaluation surplus portion might just be a part of the deferred tax impact, that the balance will have to go to P&L. So you need to understand that this 500 revaluation portion, I determined it by looking at 2 million minus 2.5. So from the above analysis, the deferred tax on the property arise partly as a result of revaluation surplus being the difference between the carrying amount of the asset of 2 million and the fair value of 2.5 million. The deferred tax that relates to this revaluation surplus will be recognized in the other comprehensive income, while the remaining balance of the deferred tax will be recognized through SOPL. And that's a technicality, yeah. That's just a technicality that you need to figure out here. Now, I'm not going to solve this. This is almost the same thing I've been doing so far. So go and look through this. They ask you to define deferred tax. I've mentioned permanent difference is difference between the carrying amount and tax base on items that are not tax deductible, on items that has no tax consequence. So, but this one, difference between carrying amount and tax base, that one you don't need to be explaining. Okay, that suffices. But this one you need to explain that, okay, this difference, so it has no tax consequences, but this one does. So again, they gave you some assets They give you capital, they are the cost of the assets, they give you depreciation, they give you capital allowance, you have to calculate deferred tax. Very straightforward. So just do this. So straightforward. So, and they ask you to do movement and all of that. I would really appreciate if you can attempt this. Don't dub anywhere. You should be able to do it from the classes I've done with you. Now, another one. Let's see if this one poses any threats. Babangida Limited acquire a factory for 10 million. The machine estimated life and residual value is this. Depreciation on a straight line basis. The taxman does depreciation of 40% of costs against income tax and 25% per annum in subsequent on reducing balance. The prevailing income tax, deferred tax charge for 2021. Okay, so go and attempt this as well. There's nothing different here. So for the fact that they ask you to do deferred tax charge in 2021, okay, and they gave you figures from 2019, meaning that deferred tax charge in 2021 is the opening and closing. So you will need to get 2020 balance of deferred tax and before you get 2021 balance. I did something like that. That's why I'm not doing this again. But the deferred tax balance is just the deferred tax position at the end of 2021. So attempt this for your own sake. Okay, I think this is a little different. So let's look at this as our final question. So this one says that accounting for deferred tax is based on identification of temporary differences. I mean, that cannot be overemphasized. I've already established that with you guys. It's all about temporary difference. We're now asked that we should explain the term temporary difference and discuss the two different types of temporary difference. So, you know that temporary difference is the difference between the tax base and the carrying amount, okay, which would ultimately jive eventually, but that's the temporary difference. And the two types of temporary difference are deductible temporary difference and permanent temporary difference. Deductible temporary difference is the difference that will result in paying or getting more deductions in the future. Okay, like where the tax base of an asset is higher than the carrying amount of an asset. That means you're going to get more deductions in the future. That will result in a deductible temporary difference. But a taxable temporary difference is that will result in paying additional tax in the future. And that's one where the carrying amount of an asset is higher than its tax base. In this case, you'll be getting less deduction, resulting in you paying more taxes in the future. So, yeah. State and briefly explain 5 components of tax expense or income tax expense. So what are the 5 components of tax expense? I think I told you this one. I kind of shown you that the components of tax expense are you have the current tax expense, and I told you we have adjustments of current tax of prior periods, adjustment of current tax of prior period. I told you about deferred tax. arising from temporary differences. Temporary differences. I told you about deferred tax arising from unused capital allowances. I told you about deferred tax arising from tax losses carried forward. I simplified it for you that way. Even this one, just for making your life a little easier when you're revising with this material, temporary difference is the difference between the tax base of an item and its carrying amount, and it is expected to reverse in the future. While the different types, so the two types of temporary difference are, we have deductible temporary difference, and we have taxable temporary difference. So for deductible temporary difference, this results in getting more, or getting past deductions in the future. Example is where the tax base of an asset is higher than its carrying amount. While taxable temporary difference, this results in additional tax payable in the future. Example is where the carrying amount of an asset is higher than its tax base. Now, the final question, which is C. This talks about Buga Nigeria Limited. It said had an accounting profit before tax of this amount for the year ended September 30th, 2022. The following balances were extracted from the company's books as at September 30th, 2022. We're given non-current assets, details, current assets, current liabilities, and they gave us some other information. We were told that interest income is taxed, while interest expenses are liable on a cash basis. There were no opening balance on interest receivable and interest payable. We're also told that the trade receivables above is shown net of an allowance for doubtful balance of 16.7 million. This is the first year that such an allowance has been recognized. A deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up. The balances in respect of office equipment are after charging accounting depreciation of 28.2 million and tax allowable depreciation of 22.5 million respectively. The freehold property was purchased on October 1st, 2021 for 263 million and is being depreciated for accounting purpose on a 10% per annum. Buga Nigeria Limited is in a position to claim 94.6 million as accelerated depreciation on the cost as tax expense in this year's tax computation. Prepare a tax computation and calculate the current tax expense. Calculate the deferred tax liability as of September 30th, 2022. Show the movement on the deferred tax account for the year ended September 30th, 2022, given that the opening balance was 8.1 million. This diet they were very stingy with marks, as if the people are waking up and sleeping on a question like that, giving 4 marks, 2 marks. So we're asked to prepare tax computation. And for you to do tax computation, you need to get allowable and disallowable and all of that. And given the fact that they give us a PBT of 196 million, and they give us statement of financial position, and they gave us some additional information, at least they told me that interest income is taxed while interest expenses are liable on a cash basis, which means that as far as this year is concerned, the taxman is disallowing interest expense and he will not tax interest income. And they told me that there were no opening balance for interest receivable and payable, which means that this interest receivable year happened in this year is entirely this year because there's no opening. So this is also the interest income that went to P&L. So I will need to disallow that, or I will need to exempt that. It will be taxed. This interest payable is also the interest expense for the year. I will need to disallow that. So that's what this guy is telling me. Also, the trade receivable balance above is shown net of an allowance for doubtful debt of these amounts. So these trade receivables are telling me that they had already deducted an allowance for doubtful debt of this. And we're told that this is the first year of such an allowance has been recognized. So they hadn't recognized it before. This is the first year. So there's no opening. We're told that a deduction for debt is only allowed for tax purposes when the debtor is in the process of winding up, which goes to show that the taxman is not going to allow this 16.75 as a deduction, because when you have a doubtful debt allowance, the double entry is you debit P&L, you credit the provisions for allowance for doubtful debt that will ultimately be deducted from receivables. So this amount would be disallowed also for tax purposes. Also, we are told that the balance in respect of office equipment after charging depreciation of this, depreciation would be disallowed. And tax allowable depreciation of this is capital allowance that will be allowed as a deduction. The field property was purchased in October 1st, 2021, which is the beginning of the year for this, and is being depreciated for accounting purpose at 10% per annum. So this 10% per annum, if you calculate it on this, it should be disallowed for tax purposes. Buga Nigerian PLC is in position to claim 94.6 million as accelerated depreciation on cost as a taxable expense. This is the capital allowance that would be allowed as a deduction. And that is it. So it is not it's easy, but it's a lot of details to note. So if I'm going to be computing my adjusted profit, well, when they say tax computation, I want to get what's my taxable profit. That's what I need to get. I want to get my taxable profit. Then at the end of the day, get my tax. So I'll start from my accounting profit, which is my profit before tax. What am I doing up here? So, which is my profit before tax? And how much is my profit before tax? I was told is this. So, okay, let me do this. So let me take away these 3 zeros. Okay. Yeah. Yeah. Okay. So I would add back disallowable expenses. I would deduct non-taxable income. Non-taxable income. Then I'll deduct capital allowance to finally get my taxable profit. So here now, in the exam, you can't do it like this. You cannot leave space like this. So just in the exam, just know which one to deduct and which one to add. Let me just do it the way you would do it in the exam. Let me not be unrealistic. Let me be realistic. So in the exam, you pick them one by one. You pick this interest income. You know that it's non-taxable. You deduct the interest income of, since this is the first year, so it's 3,250. This 3,250.
Sorry, if there was interest income in the prior year income, maybe and there's the interest receivable is different from the one in the, like, maybe interest receivable is maybe 5,000, but they say interest income is, I don't know. How will you know, like, the one for the year? That's what I was just trying
So
to.
they'll give you an opening. They'll give you opening interest receivable. So if they give us opening interest receivable of, let's say, 250, that means, and the closing is 3,250. So for the year is 3,000. Yeah. So you have asked a good question.
Thank you, sir.
That's how you know. Yeah. Then I will add back disallowable expenses, which is the interest expense. And because it's not allowed, it's only allowed on cash basis, so I'm disallowing it this year, which is this 10,250. So I'm adding it back. Adding it back. Then this allowance for doubtful debts, allowance for doubtful balance, they are also adding it back of how much? 16,750. Taxman is not allowing it. 16,750. And also this capital allowance to be deducted. Add back, I say capital allowance, sorry. Depreciation on which asset now? Office equipment. Office equipment. How much is it? 28,250. 28,250. I will deduct capital allowance on the same office equipment. How much was the capital allowance? 22,500. So in the exam, you can call it tax depreciation, since that's what they call it in the question, instead of capital allowance. Okay. How much did I say it was? 22,500 or what? Yeah. 22,500. Then for the freehold property, The depreciation is 10% per annum. So you add back depreciation on field property, which is 10% times 263, yeah, 63 million. And that gives me 26,300. I'll deduct tax depreciation on that same field property. And the tax depreciation was accelerated. So they are giving us 94,600 as a lot. 94,600. That is all. Okay. So can you give me my balance? That will be my taxable profits. What was your answer?
158.
One five what?
600.
Is this what you said?
Yes, sir.
Okay. So my current tax, what's the tax rate given? Are we given a tax rate? I can't find anyone. I'll assume 30%.
40%, sir.
Where is it? Where
I
did you
think
see
just before all
40%?
these ones. Um, but I think they wrote it just before. Oh, okay. I mixed it up, sorry, with another question.
Okay. So 30% of 158,600. So how much is that?
47,580.
47,580. Okay. So that's 4 marks for you. The second one, we asked to compute deferred tax liability. So B part, computation of deferred tax liability. So because there is a lot of items that are causing temporary differences here, like this interest income and interest expense, a temporary difference because the taxman will still allow them or tax them in the future. Even this one is causing temporary difference. The depreciation and tax depreciation is causing temporary difference. So let me just do a column for carrying amounts. I have tax base. This is how we do it in real life, sef. Then I have my temporary difference. I have my thousands. So as far as we are concerned, the first item here, which is freehold property, freehold property. So what's the carrying amount of this freehold property? Is it given that they told me that the freehold property, that the cost is 263,000 and depreciation is 10% per annum. So, which is more of 263,000 minus like this. 263,000 minus 26,300. How much does that give me?
236,700.
Which is this, anyways. 236,700. So the tax base will also be 263,000. What's the tax depreciation? 94,600. So for this one, you can do 263,000 minus 94,600. What does that give us?
168,400.
168,400. What's the difference?
68,300.
68,300. Is this a taxable temporary difference or deductible?
Taxable.
It's
It's
taxable.
taxable.
Yeah. So anyone that is taxable, I will leave it. Anyone that is deductible, I'll deduct. I'll just put the deduction there. So office equipment, I was told that the office equipment, where is it? This minus this. So I want to believe the carrying amount should be this because they are deducting tax allowable depreciation. So that means the carrying amount should be this 205. That's the book value. And the this one should be the tax base after deducting the 22,500, giving me 182,500. What's the difference? That should be 22,500. Is this taxable or deductible? It's also taxable from here. Then the next item is trade receivables. And this is the carrying amount. This is trade receivables. And what the tax base? So the tax base, because the taxman would not allow the 16,750, this one. So what's that difference? Let's remove it from the tax base.
157,500.
157,500. So the difference will be that one. And this will be a deductible temporary difference. To be a deductible temporary difference. Okay. What am I doing? How am I deducting it? They have already deducted it here to determine this. So I'll need to add it back. Since the tax, the guy said don't deduct. But yeah, how much?
341,750.
Sorry?
341,750.
Yeah.
Oh, yeah, sorry.
191,000.
91,000. Okay. Then my interest receivable. This is 3,250. The tax base, this guy is not going to allow it. So there's a difference of this that will be taxable in the future. So it's a taxable temporary difference. Then fines payable. I don't even need to include this one because it's never allowed. So there won't be any temporary difference here. Then interest payable. Interest payable. The taxman will not allow it as a deduction, but they will allow it as a deduction in the future. So it will be a deductible temporary difference. So let's cumulate it so I can know whether I'm having a deductible or taxable temporary difference. Okay, it's more of a taxable because these are higher. So just give me my figure. I know it's taxable.
$46,200.
Like this.
200. Yes.
Okay. So I'll have deferred tax liability, which is 30% times 46,200. How much is that?
13,860.
13,860. Okay, that's my deferred tax liability. And now they want me to show movement in deferred tax account. If the opening is this, which is C, movement in deferred tax accounts. What's my opening deferred tax? I was given as 8.1 million. My closing deferred tax, which is 13,860.
Sorry to bring
Sorry,
us
sir.
back. Oh. Can we check that taxable temporary difference? Like the total.
The
Please,
exact is 66,450.
66,450. Yes.
yeah, thank you. So what will be the deferred tax liability?
19,935.
Okay, so this is
So
19.
that 46,200, you change it.
Yeah. Okay, so here we have an increase in deferred tax that will result in a deferred tax expense. What's the difference here?
$11,835.
Okay, and that's the end of deferred tax for you guys. So on Wednesday, for the professional guys, we'll solve like 3 more questions on Wednesday. I mean, let's just make that as the mandate for that date to solve more questions on deferred tax, particularly more advanced questions than this, but the underlying principle is the same. You just need to look at more advanced scenarios for you guys. So that's it for tonight. Next week, we would be unveiling our plans for the diet. Of course, I'll be communicating the plans to you. Like I've mentioned to you, February is the month where we would work very hard. We'll work very hard just so that it gives us leverage against the next half of the diet. We'll be in a comfortable position. As a matter of fact, for FL guys, I'm going to finish up group account is going off our plan. We're finishing it. And the SBL guys will be joining you for introduction because as far as they are concerned, whatever I'm teaching is just introduction for them. And they will not understand what I want to teach them for group account if they don't remember the introduction. And that goes to you guys that are still writing FR. Everything we are teaching you now, everything, you still need FR. You don't forget it. Otherwise, you'll go through all this. I mean, this is like fire. This is like a whole lot of hard work for those guys in SBR, right? You need to remember these things because they would ask you again in SBR, right? And that's why we have to join you for this before we move to any advance and all of that. So let's work hard, let's keep struggling. Um, and see what we can make out of February. Thank you, thank you, thank you. Have a restful night. See you during the week. Bye.